Hello and welcome to Switzer Investing Insights, brought to you by NabTrade. It's the start of a new financial year, so let's review the strategies that will help you keep your portfolio in really good shape.
Well, let's start with your asset allocation, Peter, because the investment research says that this is the major driver of risk-adjusted investment performance. It's important to remember that asset allocations are not static, because as markets change, the value of individual investments rise and fall, meaning that the amount invested in each asset class changes.
Yep.
We also make new investments during the year and sell others. So periodically we should rebalance our portfolio to make sure that our exposures are where we want them to be. Of course, there's no right or wrong asset allocation. What's right for you depends on your own investment objectives, your need to grow capital or preserve capital, your need for income, your tolerance or enthusiasm for risk, and many other factors.
Okay, Paul, why don't we look at some target allocations?
Okay, these are shown on the screen using some generic risk profiles. As you move from left to right, the proportion of income assets, things like cash and fixed income, reduces from 100% down to 1%, and the proportion of growth assets, those assets are expected to provide most of their return from an increase in price. Assets such as shares or property increase from 0% to 100%. For example, a balanced investor with a 40-60 split between income and growth assets.
Okay, so that's rebalancing to make sure your overall asset exposure is where you really want it to be. What about the actual assets themselves?
Well, that's the next step, particularly for diverse assets like company shares, to ensure that the exposures to different industries and the drivers that will affect different parts of the economy forward are where you want them to be. We call this our sector allocation. Now, each company is categorised using a global scheme that breaks the market up into 11 sectors. These are shown on the screen together with their respective weights and some of the largest stocks in those sectors. For example, the financial sector makes up about 32% of the S&P ASX 200. If you have a view that this sector has strong prospects, then you'll want your portfolio to be overweight this sector relative to the other sectors. That is, a weighting of the individual stocks would sum to far more than 32%. Conversely, if you don't like the sector, you think the outlook for financial stocks is poor, then you'll want to be underweight the sector.
Yeah, so what you're really saying is you make sure that your biases are reflected in the allocations, so potentially overweight in some sectors that you like, underweight in other ones, but what about the actual stocks?
Well, that's the last step, actually, to check the actual stocks you've got within the sector are the stocks you
That's
actually
the hardest
want.
bit too.
And the chances are there'll be some underperformers with poor prospects. So it's time to clean up and throw out the dogs and perhaps add some others.
And that's a hard thing to do as well.
Well, it is hard to do, but it's a good discipline. And the start of the financial year is as good a time as any to get it done.
Okay, so we haven't talked about superannuation. Are there any super actions we should really be taking now?
Look, the main change for this financial year is around the consolidation of inactive, low balance super accounts.
Yeah.
These are super accounts with a balance of under $6,000 and where no contribution has been made for 16 months. There are also changes to other inactive accounts in regard to insurance cover. Now, if you want to keep your insurance cover and you have an inactive account, you will need to tell your super fund. There are no changes to the contribution caps. That's the $25,000 for concessional contributions, which includes your employer's 9.5% and any salary sacrifice contributions you make, or the $100,000 for non-concessional contributions. But the important point here is to do some planning now and not leave it to the end of the financial year. Things like seeing whether you can take advantage of the salary sacrifice. Put a place and plan to do it now. And if you want to split the concessional contributions made last financial year with your spouse, in other words, to boost your spouse's super, you need to contact your super fund before you lodge your tax return.
Okay, so rebalance your portfolio, check your sector biases, throw out the dogs, and make sure that you are getting the best out of the super system. These are all strategies to make sure that you start the financial year in really good shape. Thanks for joining us on Switzer Investing Insights, brought to you by NabTrade.